Hi, I'm Tom Lydon, editor of ETF Trends here in Washington, D.C. at the Charles Schwab Impact Conference. And I'm here with Luciano Siracusano, who's the Chief Investment Strategist at WisdomTree. Luciano, thanks for being with us.
Oh, it's great to be here, Tom.
So WisdomTree has been one of the most exciting ETF companies to watch this year. You've done some unbelievably innovative things in the currency hedge world. Talk a little bit about your ideas behind those currency hedge launches, and also, I mean, you're branching out in so many different areas. What's the thought process?
Well, the thought process is, international investing is a much bigger piece to what people get exposure to these days, and the currency piece of it is very important. And so we looked around the world and said, is there interest in hedging out the impact of currency on the international equity exposure? And there's a lot of client interest, particularly at the country and the regional level, to hedge out some of the impact of currency. That's really what got us started.
So you folks were ahead of the curve in Japan, even before Abe really got into power. And now something that started off, pretty small is over $10 billion. It's amazing.
It is, and that's the beauty of the ETF industry. You have a great idea, and it can really soar. So in the case of Japan, as you said, we were hedging out the yen inside our ETF, and this year, the yen is down about 13% year to date. That's a headwind, but because we're hedging it out, that doesn't affect investors in our portfolio. They're able to get, in effect, the appreciation of the equity market without that headwind of the depreciating yen. So that's been a very successful product for us.
So based on where we are as far as the world economics right now, and the fact that we're probably going to see higher rates here in the US, chances are dollar compared to foreign currencies are going to continue to advance. Is that the general feeling?
Well, I think we're closer to an exit strategy in the US than they are in the rest of the world, particularly in places like Japan, Europe cut rates recently, UK. We may actually end the QE tapering, the tapering of the bond purchases, and we may end up raising the short-term interest rates sooner than they do. That's the type of environment where you can actually see the dollar strengthening relative to developed currencies. And if that were to happen, that's a reason why you'd want to be hedging out that foreign currency exposure.
Is the average advisor or average investor probably not as well equipped as understanding currency risk because we've been in a declining rate environment for 30 years?
I think they saw the benefit of currency exposure as the dollar was weakening. You had huge tax cuts, you had a foreign war, you had a lot of borrowing, and you had a weak dollar for a lot of that period. But now you might get to the point where you could actually start to see dollar strength, real interest rates, in the United States, faster growth in the US relative to the developed world. And that's where you need to think about it in terms of the other side of the equation. There are certain equity markets where the currency adds volatility to the exposure, but over long holding periods, it doesn't really add to the appreciation.
Right.
So in places like Europe, it actually makes a lot of sense to hedge out the currency if you're not interested in taking on that extra volatility.
So what you've done is you've created that strategy in one packaged product where, typically advisors in their asset allocation model might have an allocation, but they're also buying that currency whether they know it or not.
Yeah, by default, they're 100% unhedged. And what we say is, do you have 100% conviction in the direction of that foreign currency going forward? And if you don't, it makes a lot of sense at least to hedge, or at least to go 50-50.
Right. So good. So talk a little bit about areas of the world that you currently have products and other things that you might be thinking about with that same strategy.
Well, we mentioned DXJ, which gets you exposure to the large caps in Japan, principally the exporters. We also have a Japanese small cap ETF that hedges out currency. So if the next leg in Japan is a stronger consumer with more economic growth, that might be another way to play the Japanese recovery. But we also just launched recently a South Korean equity portfolio that hedges out the Korean won, which historically has been one of the most volatile currencies in Asia. So that appeals to advisors who are doing country by country allocation. If you're interested in Europe, we have Germany hedged, which hedges out the euro, and the UK hedge, which hedges out pound sterling. And again, these are very effective tools for advisors who have a view on which way the currency may be heading in that country. And if they don't have a view, they're very effective because they can split the baby.
Okay, right. Are advisors becoming more knowledgeable about this type of investing? And I know your folks are doing a lot to help educate. I know you're writing is tremendous, and we actually publish a lot on ETF trends, but are we doing enough as advisors to understand these opportunities?
I think we are. You know, this year in particular, the S&P is up about 25%. One of the few asset classes to beat the S&P 500 has been Japanese equities, if you hedge the currency.
Yeah.
If you didn't beat the S&P. So I think that in concert with, you know, a major investment theme starts to make this much more appealing. And like I said, the next conversation in the U.S. is when do we taper? When do we start raising the policy rate? And in that environment, if the dollar starts to appreciate, you'll get a new driver of why people may want to hedge the currency. It's not just that the other currencies are weakening, it's that the dollar may be strengthening.
While I have you in the seat, I want to take the opportunity. Where are we 12 months from now? Where's the next wave of innovation?
For WisdomTree. Well, we don't stop. We think of it almost like natural selection. You know, in the natural world, you get mutation. You have to mutate to survive. In the business world, you have to innovate. That's our version of mutation, but we're constantly innovating. We're trying to figure out 12 months from now, where is the investment community going? What solutions do they need that aren't in the marketplace today? So we have some very interesting filings that we'll talk more about them when we can. But we're going to be first in some areas to solve for problems that investors don't need. They don't know yet that they need to solve for them. But we're going to try to stay ahead of the curve.
Awesome. Thanks so much, Luch. Great seeing you.
Thanks, Tom.
Thank you.